I think we can get started. So, I asked Chris and Jeff, and I understand that Matt is here on banking, to give you guys a better understanding of mortgages. I feel the biggest problem we have is we send everything to a lender, and when everything goes perfect, great, but we don't understand the process. We don't understand why a buyer gets rejected. We don't understand what we don't understand. And if we don't ask the questions, we don't get the answers. So I've given them an outline. This is about you. This is not about us. So as we're going through, if you guys have a question, something comes up, you don't quite get it, raise your hand. They're here to answer your questions, but we're trying to understand better so that we're more effective in the field. I don't want you guys to wait 30 years like I did before I got it. Okay, so here we go. Jeff and Chris are in charge.
Take the intro?
I'll take the extra.
Intro and extra. All right. So, I'm just going to follow the outline and we'll go straight through. Susan wanted us to talk about how a mortgage is processed from beginning to end. So why don't we start with the first phase that happens in a mortgage, which of course is you guys, and then you refer it to your preferred lender, whoever that may be. So you make the referral and you're going to send it to a loan officer. So what is a loan officer, right? I mean, you guys see us roaming around your offices and you hear us talk about mortgage minutes and you hear us talk about rates and you hear us talk about whatever. We come by all different names. You might be a loan officer, you may be a mortgage originator, you may
Home
be
loan specialist.
a home loan specialist. We all have our preferred title. In essence, excluding banks and credit unions, a mortgage loan officer has gone through formal education. We have to sit for a certain number of hours before we take an exam. We take an exam and we have continuing ed on a regular basis every year, 8 hours, whether I want it or not, I gotta go get it. If you're in a bank or you're in a credit union, you register for an NMLS number and you're done. So between the two of us, there's a differential just right there. One is an ongoing commitment to education, the other is just the registration. Now, not to take away from that bank loan officer, because the bank and the credit union, God knows, is under continued scrutiny. So they do have their own internal trainings. They do have their own internal things that they have to succumb to and go do. But it's not a formalized process like yourself.
So Jeff, are you certified with the state or
Yes.
the feds?
Well, it's a national mortgage loan. It's a registration system through the federal.
And you're registered with the state.
Depends
Yes,
on your
there's state
setup.
regulations and state
Okay.
regulators, right? We're issued a number, an NMLS number, and here's something, we're going to go off topic right away. Because something shiny goes.
No.
I get an NMLS number, it goes on every one of my applications. My number goes on that application. Your license numbers goes in every one of the applications at closing. We document who the realtor was on the transaction. When a title closes a loan, we document who the title agency was, who the actual loan closer was. All that data is filed and centralized and goes to Fannie Freddie and then any regulator who wants to put their hand in and touch it. If there's a pattern that begins to come for early payment default with FHA and HUD, right? So they look at the Grand Rapids market and they see a spike in foreclosures in a certain area. They'll pull loan officer numbers, they'll pull realtor numbers, they'll pull license numbers, they'll pull title company numbers, they'll pull appraiser numbers, and see if there's commonality amongst all of those. So that was off topic, but it's kind of interesting to have because the idea of collusion starts to go away as soon as you realize that they're watching every single thing we do, every single time, right? So a loan officer then takes the data from your borrower, and all I'm trying to do is sift through all the products that sit in my brain, and there's way too many of them, and say what pieces of their profile fit into which category, and it all begins to fall down and ends up in one spot. And you guys know what the end result normally is: FHA, VA, RD, conventional. And that's where the pool ends. But we may start with a DSCR loan. I might start with an I-10 number. I mean, there's all kinds of different pieces and ways. But yeah, my job is to figure out where it's supposed to be and then take the data. So that's the loan officer.
What would you say separates a good loan officer from a great loan officer? There's a lot of things.
There's a lot of things that go into that, right? But, you know, you're talking about technically with a loan application, you're talking about.
Just in general, like what separates, because there's a lot of good loan officers that get good results, but what separates that from a great originator or a great professional in the industry?
Well, I think somebody that cares and is a professional, right? So if you're not constantly absorbing information about what's going on in your environment, then you're behind. Right? Anytime there's a news release about a new product, it goes into my brain, how can I use that in a sales environment? Anytime I read anything about the real estate community, it goes into my brain about how can I disseminate that information. We're having a morning meeting, or we're having a discussion over coffee, or whatever the piece is, right? So you're constantly learning and you're constantly pulling in information about the industry that we're in, and then how does it apply in any given situation as you're out and about in the community. And that comes right back all the way to the borrower who sits across the table from you. Because if you know that Mister just recently said you can do a single wide trailer now through the Mr. product, and you couldn't before, well then you're 2 steps ahead of your competition who still has 15-year-old regs stuck in the brain.
Right.
So the difference is whether or not you're soaking up the knowledge and whether you categorize it and then use it for sales.
Yeah. For the benefit of your agents, right?
Yeah, 100%.
So how would you answer that question? How would you answer your own question?
Yeah, I think, and I was gonna maybe open with this in a minute, but you know, there's a law in business, law of the iceberg, right? Where 10% of what makes up Sue or Jeff or myself is visible to our peers, our team members, and those around us. 90% of what makes up that person and that professional is below the surface. You don't see it, right? And a lot of that foundation is where we should focus as originators, right? You're soaking up knowledge, you're building your team, you're investing into your team, you're constantly innovating to be the best that you can be, building on that foundation. And as you do that effectively over time, it pushes more and more of what the industry sees above the surface of the water, right? So I would echo what he says, not to steal what you said, but it's constant learning, it's constant innovating. But I think it really comes from a base of true purpose that's for the client, right? We really need to want what's best for our customers, and that's what drives constant innovations on the contracts or dot loop or whatever else you guys are building to build a better process and experience for your client. You actually care about the people you're serving. And I can tell that Sue cares about, and you care about, the agents that you're serving in this office. Like, it's obvious to me. So I think the great originators realize that law, and they're constantly working on themselves and their teams and building them up. So, anything to add on originator?
No. No, we can go on for hours with this.
We could. Processors. I'll hit processors real quick before you hit on learning. And again, this to me is part of what is below the surface, right? Find any great loan originator or business professional, and I'll show you a fantastic, well-developed team. It is the team, at the end of the day, that causes that loan originator rise or fall. Sure, we can work a lot of hours, but like, we really do rely and trust the team. There has to be great trust around the team. So the processor's job and role is, once a loan officer has turned in a file to the operations team, it's typically the loan processor who picks up that file next. We are very, very anal about our originations. We have not denied a loan in 3-4 years across my team, just because we're really, really, really thorough on the front end. And that can be frustrating at times because, you know, we want to move faster sometimes, but there's so much time lost in process when a deal is blowing up and a problem was made, and it's often traced back to a loan originator who cut a corner. And so we turn in really, really clean files so that the processor can grab that file, review it, get it into underwriting, and really deliver on the commitments the originator made and the process and product that we promised to the client. The commitments we made to the client, we want to be able to deliver on. So they're reviewing underwriting guidelines, they're reviewing the income calculations that the originator did, they're reviewing the transcript of underwriting that the automated system created for us. They're, like I said, looking at all the documents needed to originate that file. Cash, credit, and income. So bank statements, maybe pay stubs, and the credit report that we pulled. I'm noticing, and you can let me know if you're seeing this as well, but I'm noticing that as time goes on, And as technologies are added into the process and more of the underwriting becomes automated, I'm noticing that the processors are often solving higher level problems. They become almost a junior underwriter, and the underwriters become senior underwriters. In that, you really do need an experienced processor to be exceptional. You need an average processor and a good technology platform to be average. So again, starts with a quality origination and constant training development within the team. But the processor in our system can act a little differently than others. I have my processor do everything from sending the disclosures, submitting the loan to underwriting, reviewing all the underwriting conditions, collecting those from the borrower, interfacing with the communication with the realtors and the agents and the clients, getting all of the final numbers, hopefully 3 days prior to close, send a summary email with expectations for closing, a copy of the statement, allowing the originator to call, review everything with the client before closing and make sure there's clarity before the closing. So we do what we call an end-to-end process where the processor is really the point person from start to finish. And again, as technology innovates and makes the process easier, I just think things are converging. There's just less and less that real people are going to need to do as time goes on. I think overall for the better. And so I don't want communication to be handed off to somebody and then to somebody else. They've got to get familiar with the file and then it's handed off to the underwriter and then to we really want one person owning that process because it creates a very fast closing process with fewer redundancies of people getting familiar with the file. It's almost the engineering of a mortgage from start to finish in the loan process. And I see that processor as the key, like the absolute key to a great experience for the client. My job then, I can update, I can follow up, I can communicate throughout the process, but really it's the processor who's doing a lot of the heavy lifting. Anything you'd add on processing?
Validate and verify. But,
Yeah, trust and verify.
Yeah.
We trust your clients, but we're going to verify everything.
Right, so that is their job, their task with that. Not necessarily in my world in my office, but in my world as Jeff. I really like talking to people. I'm an originator. I'm out having discussions, right? I'm flying up here and saying yes, and I'm obligating a processor to a lot of things they don't even know I'm obligating them to. And then we obligate, and then I turn in a file, and then she goes through it, and she dots the I, and she crosses the T, and I say she because it's Kim. It could be Matt. It doesn't matter who that person is, but that person holds me to task and makes sure that what I submit is actually true. And it's clean, and it's concise, and it's the way it's supposed to be before it goes in, because I'm in sales. Move on. Next. I'm bored. Next. So that's what that person is in Jeff's world. What you just described is exactly what happens in the office. The process is basically, we fill it out and they clean it up and they send it up to the underwriter. Next on our agenda here is what's an underwriter. The underwriter is the gatekeeper. They're the ones who say yes or no to your money, ultimately. I input the data, I run AUS, which is automated underwriting system. It can be DU or LP, which means I'm going with Fannie or Freddie. Don't worry about what those things mean. It's just I put data, hit a button, it says yes or it says no. That's what you need to know. If it says yes, I hand it to a processor who validates and verifies. They then hit the button and it still says yes. They send it to an underwriter. Underwriter goes through and says, okay, everything's been validated, everything is aligned, is it all true? Oh, I have a couple of questions. So in my world, I don't call these conditions, I call them questions. An underwriter just has a question. We have to answer the question. So we're going to collect the answers to the questions, I'm going to submit it back in, and that's when they're going to say, that makes sense, yes, I accept it. They push the button, the machine says yes, or the machine says no, and it moves on to the closer.
Okay. Yes, very well done.
What's the usual time frame from the underwriter to the closing with both of you
It can
gentlemen?
be multiple, right? So
Depends on the type of loan, probably.
No, not necessarily. My underwriter will ask me questions. You give me answers to the questions. I turn it back in. So let's say it's, show me that you have enough funds to close. So I've got January's bank statement. I have December's bank statement. I do a transaction history to catch up to whatever's going on to show that I have enough cash, and suddenly $10,000 shows up. Now I've got another question. So you're not closing.
That's never happened, has it, James?
I send it back to underwriting,
All
another
the
question
time.
comes up. So until you stop asking questions, until that person stops asking questions, I can't set a closing. And I can set it, but I'm not gonna hit it, so I avoid setting it if I can. Because I don't wanna have expectations of Tuesday, and now it's next Tuesday, and then it's the following Thursday, it is, right? So what's a normal time frame? 24 hours.
Yep.
I turn it in, I get an answer, it comes back out, and in today's world, it's probably 3 hours. Because they're not overly busy. Less than.
So it's interesting, so you said you collect the initial
Yes.
whatever, and you input it, and it says, at that point, it can say, no.
Yep.
No way, but then, you know, right? But then do you then, is that final, or like, you know what I mean? Is it
Great question.
pretty much final?
Have
There'll be
you seen
something
the
that's,
movie- Have you seen the movie Dumb and Dumber?
yeah.
So
I
you're
mean,
saying I got a chance.
no, but it's just interesting, like.
Dumb and Dumber.
Dumb and Dumber.
Oh, yeah.
That was years ago. But
Yeah.
so you collect data, you're putting it in, and there's whatever it is, it'll say yes or no. So if it says yes, then it goes on to the processor, and at that point, it can still say, based on what they do, you can still say no.
Yep.
Right? Okay, just trying to understand, because yeah,
Every time it moves, it's validated.
right.
Because you want to make sure that it can actually, by the time it goes to an underwrite, because we're charged for an underwrite. I mean, I don't know about your work.
Oh, okay,
I'm
yeah.
charged for that.
Yeah,
We're
gotcha.
talking about collecting of assets for the processor, and it's becoming more and more, press a button. If you link your accounts to my machine,
Yeah.
I can pull down all your banking information, I can pull down all your investment information, I can pull down pretty much everything about your life, it funnels right into my machine. Okay? That has an expense associated with it. So you're seeing cost rise. And that's something for a different day, but it's getting easier but more expensive to get along for all those reasons. But so we're validating as we go, we're pulling back in the information to make sure that before it moves to the next step, I'm not wasting money and I'm not wasting anybody's time. And Chris has heard me say it, and I know they operate the exact same way. We're going to give you good news fast and bad news faster. Because our bad news sucks. Our bad news stops transactions. Our bad news stops you from getting paid. Our bad news means that you have to cancel a moving company. Our bad news, our bad news transcends and sends over. So we're trying to find the bad news as fast as we possibly can.
So at what
Sometimes the
point?
solution is time sensitive too.
Yes.
Like if you get a bad news to the agent quickly and client, I've had almost always there's a way to fix
Yes.
the bad
It's
news.
something, okay. Well, I was gonna say, at what point is it like a pre-approval? Is it when you,
The very first one, I
That's
take
like, so if it
it,
says
I hit
yes,
the button, it comes back and says yes.
that's
you
like
can pre-approve.
pre-approval,
Yeah.
and then you can start, okay, gotcha.
Yeah.
The way I look at those, like, to me, a pre-qual, you can run automated underwriting. A pre-approval is when you've got actually some paperwork to back up what we put in the system.
Those are different, yes, right?
Yeah, and then pre-underwriting would be, even prior to contract, we send all that package over to the underwriter, they review, approve. That to me is the most sturdy, safest way to do a pre-approval.
However, pre-approvals, depending on the lender, can be goulash or valid.
Right.
Yes.
Right.
Right, okay, yeah.
Yeah, in our world, it's like we're gonna talk about Quicken loan officers in a little bit, but like, that's one of the biggest differences, right? Is that we actually place a premium on quality because our reputation in a community like this is tarnished quickly with a mistake, right? So we really can't afford to have a mistake. So, yeah, I'll let you continue, I don't wanna take.
No, it must be done because it was underwriting, now we're closing.
Closing. So we have a closing team, and we get assigned a individual closer on our team. Her name's Maggie. She's fantastic. And the closer's job is going to be to work with the title company. This process can be a little bit confusing, I think, especially for newer agents. It's like, what actually happens between clear to close and the funding table? I just find that there's so much uncertainty. And the problem also is that also depends on timeline, how quick we're moving, what kind of transaction it is. But ideally, we're gonna put together a closing statement with all of the numbers that pertain to the lender. What interest rate was locked in, what fees, were there points. We're gonna take our draft of the closing statement, we're gonna get it signed by the borrower, even if it's not totally finalized yet, because there's a 3-day window from when that document is signed to when we can be at the funding table. With enough time, oftentimes those numbers are final. But even if they're not, we're gonna send a draft, have it e-signed, and submit a copy of that to the title company. The title company then looks at any invoices they've collected from all parties, right? There could be a lot of things you guys have negotiated on the seller side or the buyer side of the transaction. They're gonna go through that settlement statement and submit back to us a version that should be pretty dialed in, pretty much all the invoices from all parties. And then our closing team's gonna review that. If there's any changes, we'd submit that back to title again. But usually not. Usually those numbers are final, we'll approve them, and then we'll have a totally approved final settlement statement. For us, it's a closing statement. Title companies have an ALTA statement. But it's the closer's job really to own that communication and to make sure that as quickly as humanly possible, we get everything scheduled. I guess maybe agent and title are gonna schedule, but we know when it's scheduled, we know what the numbers are supposed to be, and we work with the title company to get the finally approved numbers. As soon as we have that in our process, we'll send them a separate summary email of, here's your monthly payment, here's what to bring to closing, here's a copy of the settlement statement. And then I'll either do a video walkthrough of that and make sure they know exactly what every line item is, or better, depending on their schedule, get on the phone and review that from top to bottom. Closers, I don't think most agents or you won't typically interface with the closer. They're typically communicating with the loan officer, the processor, and the title company. Maybe via email, but oftentimes it'll just be you and your loan officer communicating about the timeline, what's scheduled, what are the final numbers. Any questions on closers? Pretty simple job, it's just they do a lot of volume. I feel like they don't have a huge scope of work, but they do a lot of files.
Susan brought up to go to the closing because there was an issue that came up with somebody not getting their commission. If they do it by Zoom or they don't want you there, like in person, I mean, what's going on with the technology with that today?
They being who?
As far as the actual closing, what if the closing is somewhere that's not in this area and you can't physically be there? Are they doing Zoom for those closings to make sure that you're part of that closing with the agent?
You would have to arrange for that.
Yeah, for instance.
Yeah, that ends
That
up
brings
with the
up a
title
good point.
company. You need to be.
Either in person or on Zoom
Yeah,
during that closing.
and every title company is gonna do it a little bit differently. There are several options right now at Trans where, I actually went down, I had a notarized closing with people in Alaska. And I went down to be at the closing to the downtown office so I could be there. And of course, they had technical difficulties, which I understand happens all the time. And 2 hours later, it closed, and I wasn't there by the time it closed. But as the technology gets better, Chris, we're gonna be able, I think the key thing is if you have a mail-away closing, or a Zoom closing, or a notary closing, you need to look at that closing statement.
That's the key.
You better know that that closing statement's not gonna be changed. That's where the trouble's coming. Things are being changed.
So if you're doing Zoom, could they still change it even though you're on Zoom? You might not even know it.
Well, I think
You would know it?
Yeah,
Okay.
because the buyer has to be presented with that, and the buyer has to sign that.
Okay.
So they will know if there's revisions, especially if it's at your table, because this one will come away and this one will come in.
Sure.
Yeah.
So that's
Well,
handled.
I think that's going back to the one closing we had, it was on the seller side only, and it was not our seller. And we never were presented with the seller side documents. So you have to ask for them, you have to make sure you look at them on any closing.
Maybe quick add, there's 3 main types of closings. You'll do a full doc at the table, signing everything. Most of our closings are gonna be a hybrid, which means through Simple Nexus app system that we're using for taking applications and processing the loan and giving updates on the process. Same thing Fairway has. We'll do a hybrid closing. What I love about that is they get out of the way all of the lender documents. They can e-sign that while they're having coffee that morning. Has to be signed day of closing, but it drastically reduces the paperwork load at the closing table. So that's not a fully, like the RON, the electronic Zoom version of a closing. This is the hybrid, which is in between a full doc and the RON closing. You pop online, e-sign all the disclosures, and you show up and you're mostly signing title documents and title transfer type documents. And that makes for lender doc mistakes really drives down the chance of, you know, getting your initials wrong or whatever it might be. And they've seen those documents multiple times by that point, so there's almost never questions.
They're known.
Yeah, they're like, just send me the house. Yeah,
When you say Nexus, do you mean LexisNexis?
no.
That's right. That's right, on the backside when we do fraud reports.
Yeah, yeah. No, I mean Simple Nexus, which is the, I guess they changed the name, didn't they? Yeah. Anyhow, so then the fully electronic, we've done that for a couple different closings where they're just traveling and they're in an airport or whatever, and they've got to get everything signed. But I think what Sue was stressing is just make sure the numbers are right. I'd say it's early in the process to communicate with title and lender what your expectations are around the concessions, commissions, etc., the better, because it gives us time to react. We don't want to make changes day of closing. In my opinion, we really want everything dialed in 3 days prior.
I agree, and that's where the problem came, Chris. Things were all last minute and changed last minute.
And that can happen. You can have a file where lenders delay, and now we're like 2 days going to jam through a closing. Those are the ones that end up being an S show in that, you know, we don't know where the numbers are coming from sometimes.
Yeah, and they happen because we're trying to hit dates.
Yep.
Because of the stuff we talked about, changing movers, changing move-in dates, changing vacations.
And sometimes for legitimate reasons.
Yeah, we'll jam them through.
Yeah.
They're gonna, we call it a clown close, clown car closing, right? Where the little tiny car shows up, the doors open, 19 people fall out. That's exactly what those look like. We'll do it. But
And it
you
can
all
be
know,
for
my hands
leg-
raised, this is gonna be a clown car. You're ready, here we go.
I mean, it could be for good reasons, right? The appraisal came in low and we took time for the negotiations to go through, or the seller was dragging their feet and they're like, well, we'll do it, but we gotta close in 48 hours, and so lender's like, we've got everything, but we need the addendum, let's crush it,
Yeah.
right? Like, so there can be good reasons why. So, anyway, that's closers. Any other questions on closing process?
So talk about Quicken.
Okay.
These,
We
and
have
we should say any, Quicken's not the only one. They're
Internet lender.
internet lenders. This is
Out
a
of
big,
state internet lender. You wanna start?
Go.
Okay. So, here's the big difference. Quicken gets the originator paid to originate deals. I get paid to close them. Right? I actually have to see that file all the way through to the finish line, meaning the absolute duck of a file I might originate, I have to be the one to pick up the pieces if something goes wrong, right? So that's the first thing, is I don't really think those loan officers are incentivized by the right thing. We're not getting paid to get yeses and then just figuring out over volume. We are getting paid to provide an experience from start to finish that is enjoyable and referable, because the most referable lender for you is the lender that's going to help you build your business best, hands down every time. Now, the way I differentiate what we do versus a Quicken Loans is I just explain to people, like, I have a heart to serve my clients, and our job, instead of push button get loan, is to help you find a loan plan that integrates best into your overall financial goals. If done correctly, I will save you the most money, all things considered. Right? So we're not just trying to push button get loan, we're trying to originate a loan that, all things considered, saves you the most money. If you get into a house that crowds out your ability to save for retirement, for example, how am I helping you to build wealth for your future if I'm just pushing you to the very biggest house for you? You know, again, I'm all about people buying great, nice, big houses, but I want it to fit for them and for them to save money, build wealth best through the way we built the plan. Additionally, people will ask about rate when it comes to Quicken, and I had an experience just recently where the customer said, hey, 5.5% rate with Quicken. This is a friend of mine there, why should I use you guys? We're talking. Turns out, through the process of going through the numbers, she was quoting more points than would be legally allowable. There's $50,000 in origination fees on this loan to get what looked like a below market rate. But that's all they know to sell, right? That's all they know to communicate to the client. This was one of the more egregious examples of that. It's like, that was not the cheapest loan, all things considered. They were just selling what the customer wanted to hear, not educate them. And so it gives me a great opportunity to open it up and say, hey, there's 3 main things about rates you need to know. Did you know there are 30 variables even more if you look at all the LLPAs, but 30 main variables when you look at loan program, down payment size, escrow, no escrow, timeline of the closing. It's like there are 30 variables that determine what your rate is going to be, and based on those 30 variables, there can be as much as maybe a 2% swing in what rate you're going to get. And so we educate. We're not going to be push button get loan. We're going to structure a mortgage that out of all those variables is going to be right for you. Secondly, there's this market movement based on the bond market, and you're huge on this, very, very sharp on what's going on in the bond market, when should we lock in the rate, what are some things we can do to mitigate rate throughout the process. And then third, there's this thing called points, right? So we're going to teach them about the 30 variables that impact their rate, the market movement, and then what are points, how do they work, are there situations where we can't avoid them, those types of things. And we just set great expectations that way. And so the reality is, and this hasn't happened in a while, but we're going to lose some deals to the internet lender just because the client digs their deals in or they think they know what they want. And Quicken, I don't want to make them completely wrong. They've done a ton of refinances and make that process really easy. There's things I can learn from Quick and Convenient. So I'm not here to badmouth Rocket Mortgage. This is just the way, the high value process I want to bring to each customer I would serve.
I think one of the things I wanted to point out, you kind of touched at it, Chris, is that they get paid for originating, not closing.
Mm-hmm.
So I think one of the things that has to be highlighted here is that that Quicken lender takes your loan, gets you your pre-approval, and never touches your file.
Mm-hmm.
They literally have a script, a follow-up script they can call from. They never look at your file. So Quicken Loans, the week before closing, is when you find out if you really have a loan or not.
Yep.
Whereas if you're going with a Chris or a Jeff, they're looking at that file every week. And they know if a problem raises its ugly head versus the week before close. So when you get a lender calling you up the week before close, you know they didn't look at the file.
Ouch.
Am I right?
Yeah. You have a question?
What is the legal limit on first discount points?
It's typically, so there's an ATR QM, points and fees threshold. And that depends on the type of transaction, but it's typically going to be anywhere from 2.5 points to 3.25 points. Sound about right?
That's right.
And that's if it's a conventional
Yeah.
FHA too. So, so 2.5 points. And again, it's okay to buy points.
Yeah.
I have no problem with that. I just want to make sure we chose a loan program knowing what the future implications of that loan structure were.
For the dumb guy in the corner here,
Yeah.
I've never understood points.
But you got a great.
Thank you. Close your eyes. Can you like dumb it down 101? I didn't understand it in class. I just don't get
Okay,
points.
so point. Okay, so let's say you have a purchase and you end up with a loan amount of $200,000. So you have a $200,000 loan amount. And let's say you wanted to buy a point. And a point, what it allows you to do is essentially prepay some of the interest on the loan, giving you a lower interest rate. And your hope as a consumer is that the lower interest rate is going to generate some sort of a savings over time. So to quantify that more clearly, a point is going to be 1% of whatever you're financing. So on the $200,000 loan, think 0.%. So, you know, your commissions are 3 points of a purchase price. Our points are 1% of a loan amount. So that 1% on a $200,000 loan amount is going to be $2,000 worth of a charge. What that'll do, historically it had been around 0.25%. These days I see a point sometimes be 3/8, sometimes be as much as 0.5% in benefit. It really, now more than ever, it pays for a loan officer to be looking at all the different rate options to find the one that's most efficient for that client in their scenario. But for round number's sake, let's say you have a $200,000 loan, you're going to pay $2,000 for the point. That's going to generate, let's just say, 0.25% drop to the rate and savings in their monthly payment. So I'd ask you guys, what's your guess on 0.25% drop to the interest rate as savings per month on a house payment? If you had to just stab in the dark guess, be bold, be brave, what is 0.25% on $200,000 save you every single month on your house payment?
$20.
$50.
I was at 100, 150.
But here's the funny thing, you laugh a little bit, but like that's the range clients will tell me that they think their interest rate point, that 0.25% changes. So it ends up being $28. Boom.
I went,
Well, that's important. It's important because again, rate matters, and fluctuating rates in the market matter. And honestly, like, we're not the cheapest, right? Neither I or Jeff are going to sit up here and say that we're always the cheapest. I think through strategic planning, we can save them the most money. We can help them build wealth better. But you're going to have your low-cost lenders undercut or be desperate enough in the winter to do loans for free for a while or at marginal profits, right? So we both want to deliver an exceptional experience to you guys. So we have to keep great staffing. We have to keep great people, right? So, 0.25% sounds like a lot. It really does. But when you quantify and say it's $28, like, that's 10 grand over 30 years. Are they really gonna have a house for 30 years? Probably not. Like, we're probably talking about hundreds of dollars in different costs over when you really map out the difference for the time period that first home buyer or move-up buyer would have that house. I mean, if it's 10 years, we're talking, what, 3 grand? And that matters, don't get me wrong. I want to stay competitive, I want to stay cheap as it were, but I'd rather drive the best value for the advice that we're giving. Yeah. So $28 divided by 2,000 is going to be 71 months or about 6 years for their break-even point. Now again, lately I've seen those points generate a little bit more savings, so sometimes the break-even ends up being anywhere from maybe 4 to 6 years.
Would it be better to invest that $2,000?
Well, then it should double every 7 years. Yeah. And you're right, instead of in 10 years or 30 years having saved 10 grand, 30 years it's doubled 4 times, so you're
But then
probably
do you educate people like that? You sit down and say, hey, I mean, that's kind of what I know you have this whole,
one of these days I'll take you guys through my buyer consultation.
Yeah, but that'd be great, because people don't, the normal average person doesn't even think like that or understand that, right? Because you're not dealing
No,
with that
because
every
you're
day.
always, your thought process is, oh, 5 points, a lot slower.
Yeah.
What if they refinance in a year? It's like, what a bunch of wasted money.
Exactly.
Yeah.
Just keep, what I think you need to know about points from a sales perspective is that your investor will always get the same return. They're always going to have the same yield. And all points are doing is adjusting the yield and the rate. That's it. The house always wins, right? If you go to Vegas, the house always wins. The investor always wins. So if you want 5.5 with 3 points or 6.25 with 0 points, it's the same freaking return to the investor. That's the point.
Veteran loan, no points, correct?
Pardon me?
Veteran loan, no points, VA.
You can buy points on VA loans.
Points.
In fact, VA loans don't have a limit.
Oh, wow.
So you can go, and just so you know, if you want to go beyond the ATRQM points fees threshold, if the seller concessions are being used to pay for the points paid by the seller are not included in the ATRQM, so you could do 5 or 6 points, and maybe that was the loan officer's goal with that deal I was looking at. So it's interesting how it is confusing. I'll be honest, like most loan officers don't know what points are. It's so sad to, like, they don't really get what it is or how they work.
Why?
Truly. Like, I don't think I did for like a year or two. Like, I'm embarrassed to say, like, I don't think I really fully grasped. So if there are people in this room that are saying, what in the world are we talking about? It's because it's a little confusing how that'll look on a rate sheet. But point is we want to choose the rate for the period of time that they own the home that's going to maximize their total cost. Yeah, that's going to be the cheapest overall for the period of time they own the home. And what really helps is when the agent is introducing us as the mortgage advisor and expert and teeing us up to be able to say things that sound wrong, like, hey, in this case, a higher rate is cheaper for you. That sounds wrong, but it's the truth, right? Because if we could, for example, and this is harder and harder to do these days, but if, for example, I could bump the rate up above the par rate, like let's say the rate was 6% today and we did a 6.25 rate, and I could give credits towards their loan and we knew they were going to refinance within a year, with a reverse break even of 4 to 6 years, that's the cheaper loan. I'd rather have them cover some closing costs. So again, harder to do these days, but it sounds wrong to say that, but it's just by the math, the truth. And so the better we're teed up as originators to have those conversations, like go talk to our guys, I know for sure they care about their clients, they'll find you the mortgage program that's cheapest, all things considered. It really helps us to have those conversations from a foundation of trust and not sound wrong, right? When we're referred to, when 3 lenders are referred, close your ears brokers, when you're referring to 3 lenders and all they're looking at is rate, it's very difficult to coach. And I get that a lot of, and I don't know if that's how you guys run things here, but it is a liability to a real estate team if you're referring only one lender if they do a poor job. But we want what's best for our clients. I know that for sure about Jeff, and I know that for sure.
Do you guys, between the two, you have a different expertise that we might choose one of you over the other? Or how do
Boy,
you?
here we go.
Yeah, right.
Want arm wrestle?
Yes.
I mean,
No, so what you're gonna find for yourself is you will end up, I'm speaking for you, I'm sorry.
Yeah, that's fine.
I often find that the people I work with look like me internally and act like me as I emote, right? So if you find someone who's incredibly conservative and needs to have things in a linear path, you're gonna send them to Chris. If you find someone who wants a feel, how you doing? Great, man, how you doing? We're gonna have this interaction, we're gonna go back and forth, maybe that's coming to me. I can tell you that from a technical standpoint on loans, you won't swing and miss if you refer it in either direction. I can tell you that I don't have any problem referring people to Chris, and will continue to refer people. There are things that I just plain can't do, and I'm gonna tell you I can't do them, you're gonna go here, right? You got 30 acres, and you wanna sit on it for 5 years, and you're not gonna have a house on it, we're gonna go to Greenstone, we're gonna send you over there, right?
Okay.
We're gonna be a resource for you, and you're gonna figure out how you feel when you talk to either one of us. And then you need to measure how that feel is going to be with your client. You're in charge of that, right? You'll determine this. You know how they're gonna act, you know how we act, because you see us. Does your client match? If they don't match, don't send. You know, push button, get along.
Send them rocket.
Right? Yeah, I mean, there are some people that come nervous, you'll have a conversation on the phone and I'll intentionally listen to you.
Rock, paper, scissors.
I don't want this. You know,
For better good.
Right, correct.
For better good.
Sure.
And I would add to that, like, we both have a purpose towards helping families have a very bright financial future. Like that energizes both of us when we can impact people to that end. I'd say I'm very much a Dave Ramsey fan. I followed his principles for a long time. And so what I seek to do in our mortgage process is just weave his financial principles through our buyer consultation and through the process. And I know you would do the same thing. If someone communicated to you, I want to be debt free, you'd show them the best way to be debt free fast.
Well, yeah, I mean, here's a personal point about Jeff. Right? I went to college, I paid for my own school, I was 5 years in school, there was not one credit card I didn't apply for, that they didn't send to me, that I didn't take to a bar.
Oh, no.
I came up with $28,000 in credit card debt. Wow. Right? That wasn't even my student loan, that was my credit card debt. I gave them a name, I carried them around, I found Dave Ramsey, and I paid them off. So that's just an attestation back to the Ramsey philosophy and to the, how do you dig yourself out of that crap, right? I mean, my motto in school is you can retake a class, you can't relive a party. I'm still kind of the same way, so I mean, so, but to your point, digging out is something that I had to do. I've got experience at it. Right? I mean, it's heavy lifting, man. That is not easy, and that takes commitment. But then you also need the time to sit down with somebody, and your point is valid. That all I ever hear is, "Hey, what's your rate? What's your fees?" Yeah, for heaven's sakes, here we go again. I mean, how do I have this conversation? I can't offer the value. You can only offer the data. Right. So then you present the data in the best manner that you can, and then you hope that it's, at some level you can spark some kind of a contact, so you can have more of a conversation.
So if I'm hearing you correctly, one of the things we can do as agents is tee our customer up, our client up, say, hey, I get you're looking for best rate and term, but give these guys at least a shot to show you how they might overall present a much better value that will save you money.
Yeah.
Is that worth at least a half an hour conversation?
That's a great
Right?
way. That's
Yeah,
a great way.
and if you get a half-hour commitment out of them, you can celebrate rich, man. I mean, I get maybe 4 minutes.
Yeah.
On the interview. At best, I got 4 minutes.
So what I always say to my customers, guys, is I always say everybody is getting their money from the same place, they're paying the same money for it, it's how they slice it and dice it. Let's go to a lender that's the right fit for you. You know, but there's Bank of America is paying just as much for their money as Jeff or Chris. The same, they're buying money and they're selling it. Everybody's paying the same. The federal government doesn't pay favorites because Jeff has a cuter smile or Chris is
It's kind of a
taller,
better
you know?
secondary market, but that's just, yeah, I mean, it's just going down the cat markets. So, anyway.
Can you guys explain what's going on with servicing? We all see our mortgages get sold. What's going on?
I can start. Happy to have you fill in what your experience has been. And what do you mean with the problem servicing? You're seeing a lot of loans being sold to
Well,
big
loans
areas.
always get sold. But Jeff, you mentioned that there's issues with servicing?
Well, most recently has been the hack that happened. You saw First Am went down. First American get shut. They literally shut themselves down. It's like you weren't having closings at First American for a week and a half, was it 10 days?
In Chicago too?
In Chicago, that had to happen. So you have consolidation of data amongst the servicers, and they're becoming larger and larger. And so they're targets as it's coming in. So you have people who can't get payoffs. You have people who have escrow shortages and they can't get any information on escrow shortages. The system's shut off. There's no data going out. So I mean, it's creating this, you will probably see some legislation that comes in that either breaks or stops the consolidation of the servicing at some point going forward. Because it's getting so large into individualized places. But that most recently was happening there. And then when we had the foreclosures, that's when servicers got just hammered because they weren't able to process the foreclosure work at the rate the law says. And they couldn't push it through, so then they had to hire bodies, and the bodies that they hired weren't the right bodies, and that creates an even worse data set than what was there. So servicing is a very specialized place with a very small margin. And you have to have economy of scale.
So what is servicing? A lot of these brand new people, they don't know what servicing is.
Okay, well, let's keep it to the word. I'm going to service your loan, right? So you write your mortgage payment out, and where does it go? It goes to servicing. Well, what does that mean? I have to apply X amount to your principal, X amount to your interest. I have to apply it at a certain rate. If you got mortgage insurance, I have to disperse the mortgage insurance premium out to either a convention would be Archer or MGIC or whoever, or I'm going to send it to HUD, right? So I mean, I'm taking all the bits and pieces of what you send me, and I now have to take care of it, so I service the loan. So servicing is just that. Servicers get paid a certain portion of your loan on a repetitive basis.
A servicing premium.
A servicing premium, and it will fluctuate up and down. It's a wild number. It's never accurate. It's never right. It's just
What do you see as a range for that? Like 1 to 1.5, 1 to 1.25?
No, I mean, back when things were rich, 2, 2.5. And they were making a huge bank off that, but it's
Narrow.
shrinkable.
Is that different with different companies? Like some companies service their own loans if they're bigger?
Yes, companies can service their own loan. It's a risk and it's a benefit. Okay? Some have a philosophy. LFCU maintains all of their servicing here, so they will tell you they sell it, but they will tell you they keep all their own servicing. For that, they recognize a premium, but the premium is determined by them. It's placed on their books by them. So, I mean, how do you value it? I mean, it's like you walking into it for sale by owner and they tell you the place is worth $350. You're like, this is $1.75 all day, man. Right? It's just a self-determined value. Now they have to base it on something. There has to be some accounting principles brought to bear, but it's only as good as the data that we have. And then as rates move, your servicing portfolio loses value or gains value.
So are you guys saying that's gonna happen again, like this year, like happened in the 2008-ish when the market crashed?
No.
Countrywide, hint, nothing like that.
No, we don't even have, the kind of loans that we did back then, we don't have anymore.
So here's the interesting thing about servicing is like you'll have a loan servicer, but the servicer might be different than the investor who owns that loan. And the secondary market is very much trying to decide what will be the future value of this asset that I own today. Because if they have a servicing premium, let's say it generates $1,000 or so of revenue that year for that loan, they know that the cost to put that loan on the books might have cost them 3 years worth of that loan servicing to break even on the cost of it on the books. And so then they start to decide, well, based on the market that we're in, should we retain this servicing or try to sell the servicing for, say, $9,000, because as we've run how long our tables tell us this loan will perform, we're going to make a profit, right? So there's a servicing value that they can kind of estimate based on how long they think those loans will stay on the books. And so that's a big part of what drives the buying and selling of loans. If we sell a large chunk of our servicing today, that's probably a good idea because the value of that servicing is pretty low. if rates fall and suddenly those loans are refinancing, right? So now we could sell that asset and still potentially retain the servicing, but oftentimes we'll sell both the servicing and the asset itself. Anything you got there?
You had spinning yet?
I was just thinking about that in relation to commercial. They're saying that commercial real estate is gonna be a problem coming up here.
No, it's a problem now.
Problem now?
It's a problem now. But that's a bird of a different feather, maybe for a different discussion.
Yeah, we're not gonna do that today.
Okay.
But what you also need to know about servicing, before we paint them as the devil, right? Because they're just collecting money, they collect your payment, they make all this cash, and life is good. When the world goes to heck in a handbasket, and you start the foreclosures, their commitment to Fannie, Freddie, Ginnie is that I'll continue to make the mortgage principal interest payments to you.
Yeah.
So you don't make a payment, they make your payment.
Think about,
Oh
let's
my
say,
gosh.
think about this, let's say you're a real estate investor and you have to pay your Fifth Third Bank your mortgage payment every month, even though your renter doesn't have to pay you the rent.
Oh,
Yeah.
It's the exact same thing.
Same
That's
thing.
that's the
Yeah.
relationship. So they get to, there's a spread put in there for them to collect and do other data, but the minute the world goes to heck in a handbasket and you have foreclosures, they're upside down. They also have to pay to maintain the property. Your property management companies that are out there, right, they're on the hook for that. So when they come in and they lock up the house, they change the keys, they board the windows, they winterize the house, it's all their expense.
So Fannie Mae was saying, hey, six months and customers will have to start making payments again when they did the big forbearance, right? FHA, VA didn't give a specific timeline for when they were going to require borrowers to go back into repayment, which is a big part of why you saw a lot of lenders just stop writing FHA loans, because they didn't know how long they were going to have to make payments before they could start collecting mortgage payments again, right? Kind of a terrifying position to be in if you're in servicing.
that's why they all dropped out.
Exactly.
Holy schmolies, that's good information, isn't it?
Now, what's interesting too is the foreclosure market can kind of come back in an instant and disappear in an instant. And all the foreclosures that were projected during that time kind of work themselves through the system, right? And so you gotta have, I believe, a system ready to take on the foreclosure business in an instant, but not base, of course, your whole marketing strategy on it, as it can come and go so fast. So, but knowing it, being an expert, having someone like Sue who's been through that, has experience in that world, networking banks or whatever that looks like, very valuable. But of course, be diversified with your lead sources so you're not putting your eggs in that. It just comes and goes so quickly. So, any other questions on servicing?
No, I think does that give you a general idea, guys? Okay, well, I guess the next thing we want to know is, what is a portfolio loan?
You want to start?
Sure, it's my money. At its essence, a portfolio loan means that the investor is going to have a certain set of criteria that doesn't match Fannie or Freddie. It's not a secondary market or marketable property.
So a couple examples of portfolio loans would be like your DSCR loan, or debt service coverage ratio loan. There's no Fannie Mae product for that, right? Fannie Mae doesn't buy those loans. And so money only exists at interest rates that you'll see advertised because the money is insured. Meaning if a bank has to foreclose on a property, and let's say there's a $200,000 loan balance, but they could only offload that asset for $150,000, there's $50,000 lost, right? Now, Fannie and Freddie, they're insurance companies, so they're going to go and pay the bank back any lost investment during that foreclosure process, right? So, that's how money can be as cheap as it is. If you have a portfolio loan, there is no recourse for the bank in the event of foreclosure, right? They're losing all that money. So the way they offset for that risk is additional interest revenue that they can use to offset the risk of the niche product they're offering. So other examples, you have your DSCR loan. A really popular one is a loan maybe to shorten, what do they call that? Bank statement loan maybe for self-employed borrowers when they maybe only have a year history of the business, because Fannie Mae requires a 2-year average in a lot of cases. You've got your sometimes unique properties, all loans for land. Construction finance starts out in portfolio financing before we'll convert that into end loan construction conventional. there's just a lot of unique programs. It's nice to have kind of a robust set of portfolio options because there's a lot of niche reasons why a deal might not be closable, and at least offering that as an option can be helpful.
What Honor Credit Union does your manufacturers that have been moved, right? Isn't that who you use, Honor?
Yes,
So that's a portfolio loan.
yes.
It's not something you would bring to market. It's not a thing that you push out there, but it's a niche that they have.
They come up, yeah, situationally.
Yeah, it seems like the credit unions are bigger on portfolio than banks are on portfolio because they're not for profit for the member. And they still have the credit committee they go to. So, they do. And the credit committee can create this stupid loan for one person and suddenly they got a portfolio product. Because it happened to be that Bob, who has been a farmer for 45 years and has $3 million in the bank, because don't let a farmer fool you, they always have cash. He needed something, so they created a product for him, and now it's within the portfolio because it was created and there's a pillar carved out within the credit union. Right? So that basically, for lack of a better term, is portfolio. It's not mass marketed. It's not for everybody.
This is maybe off subject. Have you guys heard of the all-in-one loan?
Yes, love it.
You love it? Are they doing it here?
But you have to be a very specific borrower to take that product, and you have to be very conservative in nature with no debt or very little debt.
Yeah, but you can pay it down, you can pay down.
Dumb guy in the back corner here, what's it all in
Let's
one?
not go into that one. I mean, it's
Well,
basically a HELOC that says is the
Yeah.
first mortgage loan, and all your paychecks are deposited against the HELOC on a regular basis.
But you can pay down your loan in like years,
Close enough. Yeah, I mean, it's.
because you're paying down the interest more, right?
Yeah,
Your
your payroll is there, then you
Yeah.
spend out your payroll. The idea is
Yeah.
that your debt load is as low as it possibly
Yeah.
can be at all times.
Right.
And since interest is compounded on the loan balance, your interest expense will be lower, even if the rate's higher in some cases.
I heard about it when we were considering moving to Austin, Texas last year and decided not to, because you can't get a house hardly for under $1 million there.
Yeah.
What's the
No,
problem?
but, what's that?
What's the problem?
Right?
You could have referral
I didn't
3%.
want to do that. No, but that's why I heard about that product.
Yeah,
The realtor was talking about it.
It is a very good product for the right person. It is not, I don't feel, I mean,
Here's the thing, anything you're buying, investments, insurances, loans, understand what you're getting into and be very clear on how it works for you or don't do it.
Yeah.
A standard conventional at a low rate is a great program.
Because that product is, for all of you who are trying to catch up with what we're saying, you're gonna buy your house with this mortgage. They're gonna give you a debit card because you've got enough equity in this thing, right? You're gonna live your life on your debit card. So you're spending money like it's just money that you have sitting in the bank. It's coming off it's adding to your mortgage as you spend it.
Oh, wow.
And
So
then-
buying car
comes
payment comes
in
out of
whatever
it.
You're using your debit
You're
card, right?
using-
You
It's
buy
like,
groceries, you buy gas, you buy
back and forth,
whatever.
whatever, right?
Yeah, and then your payroll comes and pays down the
Pays it
balance.
all down, yeah.
So the goal, the difficulty for the common man is that they don't save,
Yeah.
ever. They spend all the time, right?
Except for the equity in the home.
Your equity is just ratcheting up, right? And you just never, your intentions are good, your
Yeah.
execution is poor, you fail.
But you have to be terribly disciplined, yes.
You have to be disciplined for it. And if you're that makeup, or you have a second income, or you have a dedicated source, or you
Yeah.
are,
Where I see that
then it's
product,
good.
where that product could be helpful in marketing efforts is if you do a lot of business with financial advisors or CPAs.
Yeah.
That product can slaughter in that space. So. What's next?
How to handle a CD so we can close on time or quickly.
Well,
A little bit more time spent up front saves everybody a ton of time all the way out throughout the process.
when does your first CD issue?
What do you mean for the waiting period?
So for instance, in our world, and it's different everywhere, so don't, as soon as your approval comes out, your approval conditions, your CD issues.
Yep.
It's not even remotely close to being right?
Right.
But it comes out, so your 3-day clock is started, it's done, it's out of the way. I take it right off the table.
Dumb guy question. Explain CD, what you're talking about, because I'm
So your
lost.
CD.
LE and CD. LE and CD.
Go, you take
Okay,
it.
all right. LE is your loan estimate. CD is Chris DeRuischer. Closing disclosure, which will mirror different formatting, but your Alta settlement statement with the title company, it's a different format for how we present those numbers. It used to be that you had a GFE, good faith estimate, and a TIL, truth in lending disclosure. You'll see TILs on auto financing, some of those types of loans today.
RVs.
Now, the government, in all their wisdom, took two acronyms and merged the two acronyms into one acronym. So now you have your TRID, TILA, RESPA Integrated Disclosures, and they took two acronyms and put them into another acronym. That's really great. But anyway, so the thing I like about it is it took those two disclosures and it wrapped them into one loan estimate. And it better mirrors each other. It used to be they didn't really match at all, but now you've got your loan estimate, which looks the same as your closing statement. So people can better match up, okay, what do they tell me up front and how close are we to the numbers at closing, right? So I say a little more time spent up front saves everybody time throughout the process. It's so true. Your communication to title and to lending on how you're expecting the numbers to go and what you expect on the real estate side, your title company's being communicative and working quickly with the lender. So helpful. But I think the number one way in which we get those closing statements out fast, this sounds weird, but you get your appraisal ordered as fast as humanly possible, and you get your loan to final approval as fast as humanly possible. Because even if we're expecting to work on the closing numbers prior to a clear to close, a lot of title companies seem to have it in their head that we're going to wait until final approval before we touch this thing. And so you just want your clear to close early in the process to give yourself a good week. And if you want to move it up, that's fine. I don't mind moving up our close date. But that just takes the pressure off title and the closing team to go back and forth, get the numbers right, so we can present it to the borrower, go through all the line items before closing. We just cannot have surprises at the closing table. It's just a terrible experience, very unprofessional. And it can happen, but it shouldn't be the norm. It should be the vast exception.
Thank you.
Remember studying the Frank Dodd Act?
No.
So I would say too, like if you, I don't know what your thoughts on this are, but if we have like say a 7-day or 10-day inspection window on a 30-day closing, it's not the worst idea if you kind of feel like this is a clean property, maybe not day 1 or 2, but day 5 of that 10-day inspection window. If we order the appraisal, have the lender call the listing side, have them schedule the appraisal for a day or 2 after the inspection window, we have the inspection done. If we need to put the appraisal on hold, we certainly can, so we're not incurring a cost or a fee. And it shouldn't communicate, hey, we're definitely moving forward with this thing. We don't want to take your negotiating power away. But the sooner that appraisal gets done, I think that's one thing that can delay the closing, the CD, the process is just the appraisal comes in late in the game. That's a problem. So I know we've got our board of appraisals very carefully, and we constantly want the feedback of our real estate professionals to promote to us appraisers with which they've had a great experience, so we can add those people to our bench, and that way those people get the first look at our appraisal reports before it goes to the open pool with the management company.
So 1 to 2 days before the appraisal?
Well, that's up to you guys. If you want to wait till after your inspection window to give us the green light to order the appraisal, that's fine. But I think if we order it even partway through the inspection window and communicate, hey, have the listing agent schedule this for after the inspection period, there's a little bit of risk there, but at speed, the appraisal is probably the most time-consuming part of the third-party services. Title usually moves pretty fast, insurance can get done quickly.
Chris, isn't some of that time of year because like in January there wasn't a whole lot of
That's true.
business. So you call an appraiser on Monday and they're out on Monday, right?
That's true.
And now as we go into spring market and everybody in this room is expecting it to be a huge year. As we go into spring market, it's gonna be harder and harder to get that appraisal.
Yeah, right now it's 5 days if you're in a, if you're in a suburb. It's very, very quick. But you're exactly right. If volume goes up, especially if we're adding refi back into the game, you wouldn't even see that volume's happening, but it's eating up the appraiser time for sure.
So look at the market too, guys. I really wanted you guys to really hit overlays. And what's dead on arrival, and nobody told you, and where they look for the basic requirements and the who, what, and where on that. Because I think that is where I left so much money on the table in my career. Because until Jeff started using the word overlay, and I think how many years ago did we meet Jeff?
Oh, don't date me.
But I never knew there was such a thing as an overlay. So let's start, what is an overlay?
At a central party, maybe.
So, yeah, you're right.
Yeah, Shirley's in the room.
What'd you say?
It's at a central party, maybe.
She knows I went to see him. An overlay. So, let's keep it very basic. Fannie and Freddie issues their rules, and I can find it in their selling guides. Any of you can find any of the rules for Fannie and Freddie.
Google.
Yeah, you literally type in Fannie Mae selling guide. It's as simple as that. It will pop up. The beautiful part about using Fannie versus Freddie, Freddie's definitely caught up now, is the first thing that pops up is something called Ask Polly. Polly's policy, ask for the policy, right? And it just comes up and there's a line, and you type, like you're typing in ChatGPT, whatever you want to know, and it will bring up all the information you need to know about what it is you're asking. It's the slickest thing in the world.
So an overlay is taking those basic rules that Fannie publishes, and a bank or a lender might place additional rules on top of that, overlaying the standard guidelines, because they're scared of certain buyback situations that could occur, or reasons why the bank might lose money. So I believe you guys are as well. We're Fannie, Freddie Direct. We're FHA, like Ginnie Direct, so all our government products are direct to the government underwriting guidelines. We may have one overlay with a manufactured situation that I'll mention in a minute, but very few, if any, overlays to any programs or products. And I love that. I want to be in a platform where if Fannie Mae's going to insure this loan, why in the world would we not write that loan? If they're going to insure the loan for us, saying, that means it's saleable, we can transfer the servicing, buy and sell the servicing. If it's saleable, why wouldn't we close that loan? Now, one quick thing I've noticed is that if it's a very niche program, like for example, an FHA manufactured, we can do, for sure, double wides. I don't know for sure single, I have to double check my guidelines, but FHA will take those loans in a park. And so the reason why a lot of lenders have an overlay for that particular situation is because we can't really create a big enough clump or mortgage-backed security of loans to be able to sell to Ginnie, because that program is so niche. So what will often happen is aggregators will take loans like that type from multiple different lenders, aggregate it into a mortgage-backed security, which then can be sold. So sometimes it relies on the relationships that your capital markets team might make on the back end to be able to do more and more of the niche programs, which is why, as a national lender, and I think Fairway's large, probably comparable, we're big enough now to be able to take on more niche programs because we have enough files coming from around the nation to be able to provide that. I'm noticing a lot of banks lately, they don't want to touch government loans, and most of them underwrite directly to Freddie Mac. And so there's a pretty big bank here locally that had a construction loan that I took over, because I don't think they went to Fannie Mae, and couldn't find a way to set up a distribution for an income stream and could provide a solution to the income problem that they had, because we had Fannie and Freddie. So it just gives you options, gives you more to work with, more tools in the tool belt to get a loan from originated to closed. So there's a lot of, and that's the thing, is like without knowing, every bank's overlays are going to be a little bit different. Every mortgage company's overlays are going to be a little bit different. So we can only really speak to what we know. But it's not just our overlays, it's if we are thinking about a broker relationship to cover some sort of niche program or want different rate sheets. If we're going to shop through different brokers, you kind of have to know, are there overlays with any of the brokers that you're going to place this loan with? So I think it's just, I think the big takeaway for you as real estate professionals is just finding out what the overlays are with the lenders that you have relationships with. What are your particular overlays so that you don't trip over an opportunity and not take advantage of that closing, a very closable deal that you just didn't know could be.
And most of your lenders don't realize that it is their bank overlays that are bouncing off
Correct.
that.
They don't even know.
They don't even know. They will call you up and say FHA rejected the loan, or Freddie or Fannie rejected the loan, and it didn't. It was their bank underwriting overlays that rejected the loan. And that is where I ran into problems, because until I met Jeff, I didn't realize that piece was in play. So I had loans that were rejected and I didn't think they could get a house. 6 months later, I see they bought a house through somebody else. Well, why? Because that person took them to a different lender who had different overlays. So that piece is huge.
Yeah, every lender has the right to set their own credit criteria, as long as
So
it's
at the-
applied equally across the board.
In that case, so you have a client, they're turned down. In order to keep them from 6 months later purchasing from someone else, how do you know that it was the overlay that, and how do you rectify it?
Just get a second one.
Ask the specific reason
Right.
why they're saying no.
Okay?
Again, a good lender can say yes or no accurately. A great lender is gonna give you a path forward to get the deal done. That might be with a different lender, it might be some coaching for a little bit to fix the credit score, but
It might even be at the same lender. I can tell you that
Yeah.
there have been multiple times, and I'm sure you've done the same thing, where someone will come to me and say, they're gonna deny the loan over at, I'm gonna pick on you, Huntington. Huntington, all right.
sitting right
I
there.
agree with that.
Do it right to your
I
face.
hate
Yeah. So, they're gonna turn down my loan at Huntington, and I'll say, well, why? Well, because of this. Well, have them do this, this, and this, and they'll close your loan, and I'll be blessed. They do this, this, and this, and it fixes the problem, and they close. I don't, if I can avoid taking your problem loan into my streams at the 11th hour,
Yeah.
I will show you the way to close someplace else. Because the minute you walk in my door, the listing agent thinks that I've had that loan for 3 weeks.
Yeah.
I haven't, I just got that loan, right? I didn't create the problem, that they've now, the listing agent has done nothing but feel the pressure for 3 weeks from a loan that's going sideways. They don't know that I just got this, and now that pressure is my pressure, your problem is my problem. I don't want that. I want to fix your problem, get you paid, and move on down the road. Give me the clean one. Give me the next one, right? So both Chris and myself will be a resource, can be a guide within those pieces. Let us know, raise your hand, and we'll give you the pathway.
Yeah, bounce stuff off of us. If they give you the reason it's turned down, bounce it off us. I had a credit union deal, found out that the credit union's overlay was 640. It's like, well, Fannie Mae goes down to 620,
Right.
did a pre-approval, closed the deal, customer for life from there. So, sometimes those turn down ones are way easier than I think to get closed. Like, it's surprisingly, why was this turned down?
Correct.
So, it's such a great point, and I think lenders don't love to talk about it, because if you have overlays, it's just not something as a loan officer you're likely to lead with.
No.
So ask, and not in a respectful way, right? Like, can you tell me a little bit about any overlays your company has?
I can tell you, I've come to know the lake a couple of times. I don't know what our pricing engine, most of us use something called Optimal Blue. So you'll hear us refer to OB, right? So you input your data, create your scenario, you hit the button, you say, what's my rate gonna be today on this product? Well, it goes out, and I'm gonna see Fannie Freddie, which is primarily where I land, right? But then I'm gonna see Huntington, I'm gonna see Citi, I've got about 26 different investors whose pricing then flows in along with Fannie Freddie.
Right.
The aggregator on that given day, meaning a Chase may say, I want every loan that is 720 score plus and over $500,000, we're going to pay a premium on that loan today. So Fannie's rate might be a quarter point higher than what Chase's rate is on that given day, which doesn't make sense, right? But Chase wants that product because they don't feel it's going to run off. Well, then I'll pick it. Well, Chase has overlays. But you don't think about that when you're locking your loan. You think that's the best price. Take it.
Right.
Well, shoot, now I'm stuck with their rules. I better know the rules. And every once in a while, you're like, I should know better. They got to be double. So, anyway.
And that's, I think, the critical thing is, when you go from bank to bank to bank to bank, because somebody offers a better rate, that rate may be because they're pickier about their product, and they're only gonna take the cream, they're not gonna take the milk. And you move it over there, and then you got a problem.
I want to add one quick question because somebody asked a question, didn't want to be put on the spot, so I won't say.
James.
Yes, James. The question was, is there a real estate origination fee, or I think the heart of it is how does a loan officer even get paid? Like, what's the commission? How do you get paid as a loan originator? So, I'll share, and every company's a little bit different, right? There's a vast difference from company to company in how they do their costs, but most mortgage companies are gonna have a margin set by the branch or the company. And that margin could vary anywhere from, say, 1.9 to 3%. I mean, there can be a vast difference between what their margin is set to.
He's talking about markup.
Yep, so you take the raw pricing from the government and you add in your margin. Think of it like points, right? You're gonna add a couple percent, and so you're gonna reflect a rate that allows you to deliver that loan without charging fees. It means basically increasing the rate to fit your margin into the loan. That's how it works across the industry, right? You guys charge a 3% commission. We're charging somewhere between 1.5 to 3%, depending on the lender, as a commission right into the pricing. So what happens then is the branch then sets a commission structure with the originators or sales professionals in the branch. Out of that margin, the manager might have a salary, he might get a commission on personal production, but then he's paying all the originators, and whatever's left over at the end of the day is either a profit or a loss. And so both, you manage a profit and loss too, right? So we both manage profit and losses. So just like any real estate company, after all the commissions are collected that month, is there a profit or is there a loss? Now again, so essentially what's happening is the customer is paying us a commission wrapped into the interest rate that they're being given. And so what's basically happening is we're getting paid the commission up front, which is over time recouped in the interest collected on that loan over time. Which is a big part of why you might have heard that if a loan gets paid off within a 6-month period, most banks will have in their policies an early payoff fee where anywhere near collected enough interest to justify the commissions paid to the loan officer, they give all their commissions back in the event of a home being paid off or sold. So that being said, it's like any other industry. There's a commission percentage based on loan amount. That's wrapped into the transaction. One more thing I'll add is a lot of us will have a max compensation where there's a limit to how much we're going to charge a borrower. We can't just decide willy-nilly, this guy gets this rate, this guy gets this. It should be fair to all borrowers applying for a loan. There's regulations just like within real estate, right? So one way we can do this is offer a max compensation. So especially as we get into bigger loan balances, rates actually start to fall, become cheaper, because if we're going to set a commission total of, call it $7,000 is the max we're going to charge a borrower on any transaction, once we've collected $7,000 worth of profits, the rate can start falling because we're not adding fees. We can essentially lower the percentage that we're charging. If it was 2% to start, maybe it's only really 1.5 to total $7,000 by the time we close it. We're getting into the weeds on comp. Point is, it's wrapped into the rate. Or way into the weeds. You could have stopped me sooner.
When you went to max comp, I said,
oh boy, we're going over. Okay, overlays.
Okay, what time are we running, guys?
12:37.
12:30, okay. When do the agents here know when a loan is rejected, if it was dead on arrival, never had a chance, or if it can be moved elsewhere?
You mean at, okay.
Let me give you an example, because it happened to Tim. It happened to me. We had a loan, it was a bank statement loan. I don't do bank statement loans, but we decided we'd broker a bank statement loan, right? So we gathered the bank statements, we get all the pieces up front, we submit it in, we get our approval back and approval conditions, moving down the road, right? Now we order the appraisal. The appraisal comes back, I submit that in because I want to make sure we're ready for close, because we were taking an inordinate amount of time to allow the buyer to collect the amount of funds he needed to have, because he's self-employed and was invoicing, he has major invoices coming in January. And in December, I sent in my appraisal just to get that part checked off the box, right? So I had it for probably 2 weeks, but I'm not closing until the end of January, but let's just get it done. But I didn't do it when I immediately got it. I sent it in and come back, and they said, no, that's rural property, and you need 25% down payment, not a 10% down payment. That loan was dead on arrival the minute that appraisal came in. I didn't know that they had a rule that changed my down payment amount.
Now, it was a quality origination because you didn't know the property necessarily did the right way.
I knew the property,
Yeah.
absolutely, because they were already under contract.
Oh.
No, we did the income portion up front without a property, right? Got the income approved.
Yeah,
Then he got the property, we did the full credit approval along with the income approval.
yeah.
Then the appraisal came back in. So that loan, I could have, Tim would have known, at least, I think it's 2 weeks earlier, right?
Probably could have done a couple weeks earlier.
Yeah. Had I submitted the appraisal right away. But the point of the matter is that was a debt on arrival because the borrower was not gonna have 25% down.
Okay,
But
so
the
part of
product
it is
changed.
the loan doesn't match the reappraisal requirements. So that was debt on, the
Right.
loan that you're applying for doesn't match the appraisal requirements. Okay. Another piece is, what are the reasons you have loans that are debt on arrival?
Let's say we did income calculations based on a set of assumptions for hours. We get a VOE, we get overtime income, but then the borrower's seeing houses, goes on a vacation, and 30 days later when they come under contract, their averages of incomes have come down a little bit. That deal might die because we didn't do a new pre-approval within 30 days of the origination. That could be an example. And so there may be things we can do to creatively get over the hump. We might, yeah.
Well, Tim had another one he sent a referral the other day, and the guy's credit report was fine, and his score was gonna be okay, but he filed bankruptcy the day before.
Come on, bro.
You're on a roll!
It's not on the credit report yet, but I just filed. Good to know, you're dead on arrival.
Okay,
So,
good. What else do you guys see? I mean,
You know, your approval is only as good as the set of assumptions that you use to get your approval. Your estimate of taxes, your estimate of home insurance, your estimate of the rate. And so anytime there's a material change or increase to any one of those costs could cause the deal to be dead on arrival. The property taxes are non-homestead, for example, and we may have to use the non-homestead taxes, and it's significantly above our set of assumptions for that area for the pre-approval. What else are you seeing?
I mean, that's a tough one to answer, because it's situational. It's so situational.
So much data goes into that. One way we mitigate that is we'll have our team check in with all the buyers weekly that are pre-approved. And as you're checking in with them and they're looking at houses and they're sharing with you their dreams, goals, whatever, you're proactive in running payment estimates. And you want a generic pre-approval because while you're in the field, you want to be able to move quickly, negotiate, and win. And if it's a Wednesday, you're going to show some homes on Saturday, it doesn't hurt to send some of the upper level ones to your lender for a payment quote and verifying that, hey, if we're close to the top edge of their approval, let's maybe double check some near the top.
But here's one is big, especially within our green card holder community.
Yeah.
I work at Lax. I've been at Lax for 2 years.
Yeah. Oh yeah. That's a
Paycheck
good one.
comes in, you haven't been there for 2 years, and you don't work for Lax, you work for DECA, and it's a temp agency. I don't have a history of the temp agency.
Yeah.
You're not considered permanently employed,
Right.
right?
Yeah.
But they told you they worked at Lax. They do work at Lax.
Right.
They are not lying to you.
Yeah,
However, that's not who you work for.
yeah.
So it all goes cattywampus, and that happens a lot, so you have to ask that extra question.
No, I was just thinking, like, I know there's some new people, most everybody in here probably knows, but as a real estate agent, it'd be your job to make sure that when you get to closing, don't do anything, your buyer, don't buy anything, don't sell, don't quit your job,
Don't file bankruptcy.
anything, right? But right before
Don't
we
get
sell this,
divorced.
we have closing dates. I had this happen to my house, we were selling our house in Mississippi, and 3 days before closing, my buyer retired.
Oh, no.
That's when you need the Fairway cash guarantee. And we would have bought that house,
Right?
yes.
I know, but say, I mean, like, but the, it's like, come on, so it delayed it, what, like another month or so? And starting all over.
I do want to add one point to that, because I was thinking as you guys were talking, where we've had challenges, and the majority of our challenges that we've run into over the past couple of years all centers around whether it's the buyer, it's really the buyer, not paying attention to, don't sign for somebody, don't apply for a credit card, and don't move money. We tell them over and over, we have discussions with them, tell them, and everybody is crystal clear. And you know what they do? They do whatever the hell they want. And they're like, I didn't know it mattered. You can't, it's the same, people are moving so much cash around this place, it's like, stop the madness.
Even
And
when
then
it's
you got-
coming in, they don't want, right?
It's crazy.
You gotta
There's so
account
much
for
money
everything.
flying
I make them promise me upfront at the pre-approval, and it's still sometimes that deal on tires was too good to be true. But you get it. But, you know, I do think sometimes we get into our ruts of our communication process and we can forget some things. So, like that's a great reminder. It's the basics that can really kill you.
So talking about moving money, like I know that you don't want to withdraw a big amount of money, but put it in. Like how do you define the big amount?
So that's program
Putting
specific.
in is worse than taking out.
Putting
Yeah, I
in
was
is
gonna
worth
say,
it.
yeah.
So on a conventional loan, it's defined as anything more than 50% of the borrower's monthly income
50%.
is for conventional. On FHA, those there's a lot of deal killers in the FHA world, but anything, I believe it's more than 1% of the transaction size, is that right?
Each lender
And that's a
seems to
little
do it
bit-
differently, but
And then it's
yes.
also, you know, if they have a history of having deposited cash, like if they run a cash business, there's exceptions for that. But 1% of the transaction side FHA and then 50% of the monthly income on conventional is a large deposit. Avoid cash at all costs.
Yes.
Avoid cash at all costs. And we want a paper trail for everything, so.
And if you all can do us a favor. Well, have a discussion prior to sending your borrowers in that the easiest way, the fastest way, easiest way, and the least inconvenient way for the borrower is to link their account stars.
Yep.
But that involves them they have to set up an account with us. Then they're going to link their bank account using their username and their password from their bank to our account. And that's where most of them go, I'm out, I'm done. I'm completely done, I'm not doing that because you're gonna have my username and password.
Nope.
I don't, it's a third party, no one ever sees it, they sever as soon as they're done. But I don't have to ask them for transaction history, I don't have to ask for bank statements, I don't have to ask about their other accounts. Let's say they gave me just savings, but they transferred money from checking. I just reach in their bank, all checking account, done, it's just done.
Another thing
So
that
it's
helps
fast and easy, but
with no credit score loans too, the VOA, or when they link their bank accounts, the verification of assets, can automatically pull your 12-month trade line histories for rent.
Yep.
That's like instantly, I've got all the paper trail for your no credit score loan right through that automated system. So technology is making the process easier and easier.
but they won't trust us for that. They will trust you
It'll take
before they
some time.
trust me.
Yeah.
If I say link your account, they're you're gonna retire. Not on your $15, I'm not, but okay. Right? I mean, that's exactly what they instantly think I'm gonna take their money. I'm not, but it will speed things up.
That gets into appraisals, you guys. When you're doing, what is an appraisal about, who's it for? And one of the things that I see happen with especially newer agents is a couple days before the closing, all of a sudden you get a list of repairs from the lender that have to be done on the house before it can close. We all know that shouldn't happen. You guys want to kind of get into that, and why that happens, and there we go.
Jeff does it.
So first off, your appraisal is not your borrower, right? The lender wants to know how much of a loan can I place on this property? How do I decide the risk of that loan, price it out? And it's our only eyes and ears on the safety condition of the property. So the lender requires the appraisal, and we have to disclose it to the borrower, and I'm grateful the borrower gets that. There's some negotiation implications there for sure, but it's only required because the bank wants one, right? You don't do an appraisal, or you don't typically do an appraisal on a cash loan. So, why don't you handle some of the repair items? It's the fun part, right?
Well, you're primarily only going to see repairs on an FHA loan or a VA loan. It's going to be a government loan in that nature, right?
And why is that? Like, why?
So I have minimum property requirements that I have to get to sell my loan back to HUD or to RD and or to VA, right? So we send out the appraiser goes through and makes notations of the things that need to be repaired to meet minimum property requirements. If they cannot determine that it meets minimum property requirements, they will call for inspections. So inspections aren't automatically always called for, but if they can't mandate or issue to us the fact that it meets the minimum property requirements, then we're gonna have the inspections done.
Even government loans no longer require them?
Say that again?
Even like government loans, like VA, FHA, those kind of things, they don't automatically require an inspection?
Correct. If the appraiser can't certify that it meets minimum property requirements per the 4000.1, and the head and shoulder inspection of your attic, your scuttle's been done, which is another pain in the backside, then they're gonna call for the inspections.
Okay.
So you don't automatically have to have.
No, so let's say an FHA appraiser goes out,
Yeah.
he says your
Well,
clearance
that's
between your
because
well and your.
They're either federally insured or federally guaranteed, right? So that's
Correct.
why they want everything to be, probably one of the reasons they want, right? But that's surprising, they wouldn't require an inspection.
Well, that's how they used to do it, but
Right.
things have changed.
So, but now it's only if an appraiser flags that it needs, okay.
Or they can't certify.
Or they
So
can't
let's
certify.
say
Right,
that
okay.
their work comes back and it says, I can't certify you got a 2-year life in your roof. You're getting a roof inspection.
Yeah,
Right?
yeah,
I can't certify that the well and the septic have the right,
Okay.
the minimum clearances.
Right.
You're getting an inspection requirement. I turn on the water's brown, and you have a water quality test done, right? I walked into a room and I flipped on the light switch and the lights didn't come on. No, you have an electric inspection done. Okay, so all these things lead to the next thing, but you don't know if you need that thing until the appraiser
It's not
goes out.
obvious where the wellhead is, so how close
Right.
is it to the property line?
Correct. Yeah.
Where's the drain field in relation to, all that?
All those pieces.
I guess, I didn't realize an appraiser like went that in depth.
They don't, that's the problem.
Right.
Because they could
That's
find it
an
if they want to,
inspector.
but remember, they're getting
Yeah,
paid
show
for
me-
the report, not.
Show me a house that doesn't have mold in the attic, if it's over 15 years old, right? It's
Right.
like-
It's not-
And then what kind of mold is it?
Yeah,
Right.
right.
Right, what's the chances of it being black mold? Very, very slim, slim to none, really, but.
But yeah,
So they're gonna call for that report. They're gonna put that then back into the appraisal report, and I'm gonna cut and snip and paste it onto an email out to you, then I'm gonna send you the photos, because almost every repair called for has a photo associated with it. And then they have to be done, and it does, now FHA doesn't require it to be done by a builder, it has to be done in a workmanlike manner.
Right.
You define that however you want to define it, the appraiser's gonna go back out, he's gonna sign off as to whether it was done or not done.
What's that in recollection, Jeff? It has to be done in a what?
Workmanlike manner, but it doesn't have to be done by a licensed person.
Really?
Really. 'Cause I mean, one of the things we're gonna call it is, there's no cover on electrical outlet. Well, I'm pretty sure a homeowner can go,
yeah.
put it, right, you can put it on, you don't need to have someone come
What about termite inspections?
up.
VA,
For,
depending on the county.
yeah,
But otherwise, only if called for by the appraiser.
Except VA.
But depending on the
They-
county.
depending on the county.
Yeah.
Oh, really? Okay. What counties are requiring it around here?
Around Kent County, Ottawa
Kent,
County, all your
all
major
the main
counties
ones, yeah.
locally, but if you go north, they fall off.
We just
Oh,
check,
okay.
we check before every VA deal just to verify.
Right.
I would add, if you guys ever are in a situation where you're approaching a property you're unsure, we have a great collateral department. They love helping the origination team out, so don't hesitate to send a address to me, Matt, our team, and just say, hey, like, what does your underwriter think based on the photos of this? Obviously, we can't see everything, but if you know there's an issue, like, hey, there's an electrical box that looks a little weird and it's a VA loan, run those collateral type issues past us as you're starting to approach your showings and trying to get some intel on those properties. We can't know everything, but for what we can see, we can tell you if we see any obvious glaring issues. I might know offhand. If I don't know, I'll be able to get it to a collateral underwriter who then that just creates a base for us later to come back to on a file. Also, there's obviously comps. I don't know how far we want to get into appraisal itself on what is an appraisal, but
Should we run through the other categories and find out if there's any hot button items for anybody?
Yeah, let's do that.
Just,
yeah.
give them
Well, there's a whole other side.
I know, that's my point. So,
I thought we were almost done.
Maybe we need session 2.
Yeah, there's
Well,
I was
something
just
too.
say, run through,
Yeah,
see if there's anybody out there who's got a
Next
question.
Tuesday?
I have a question.
I think
So-
one thing, I'm sorry,
That's okay.
I'm gonna just jump in. One thing I wanted to mention, when these guys get a list of repairs the week before the closing from the appraiser, that was
What?
probably on the table a week or two before.
So if we just got the appraisal and we're sending it to you, it means that we delayed ordering the appraisal because you delayed getting your inspections done. Right?
Okay,
So, that sounds like I was accusing, I'm not accusing, I'm just saying that timelines beget timelines, right? So however we are. On a purchase, we probably handle things just a little bit differently. As soon as my application is signed, I order the appraisal. I don't wait for you guys.
Love it.
I just don't. So we just go.
Kind
But
of
we-
depends on the agent for me, but yeah.
Oh,
Yeah.
yeah, you gotta know who you're dealing with, right? But
appreciate
the
it.
appraisers, they all have their own lives going on. I mean, you just don't know when they're gonna go out. And the ones where they show up on the same day, they happen, but a lot less often than the one who takes 5 to 7 days. Well, you're all in a competitive market out there, and you're all tightening your inspection windows, right? I mean, your windows now are 3 days, 2 days.
Yeah.
Okay,
No
I'm pretty
inspection.
safe.
So
Statistically,
you guys pick your own appraisers, they don't do a random draw.
they do.
VA they do.
Well, we pick who goes on our local panel. And then the AMC, if they don't respond fast enough or we go out of area, then the AMC will take anybody else who's on the approved list within the panel, or within the AMC, which is a appraisal management company. They'll just throw it out to that individual. Once we have somebody on our panel though, there's no just turning them, we can't just get rid of them, because that's.
So that's why you said earlier you want to put specific people on there that you know that
Yeah.
know what they're doing for
You want to be very
appraisals.
selective on who you put on your panel.
Okay.
And then if you start having a problem with somebody, you have to be very strategic about how you remove them, because you have to show there's dereliction.
Yeah.
You can't be perceived as punishing somebody for bringing a report undervalued.
Hakim, you had a question.
Yeah, it was just like, let's say you get a client and you begin the process of trying to get them pre-approved, but they don't get approved. And you set up a plan for however much time it is to basically fix the credit, bring down the debt. What is it that you guys do to make sure that we kind of get the deal closed? Hopefully once they get approved.
For me, it's, you're probably doing credit expert like we do credit expert, and I just set a reminder in my calendar. It pops up and says, call Sally on this date, she gave me permission to re-pull credit. And I'll get permission before I'm done, but then I verify it's okay to pull. And anymore, we're doing more soft pulls and we're doing hard pulls, especially for your pre-quals. And that can, I guess not, because that number can change. A soft pull and a hard pull are not the same. We're doing soft pulls so that your borrowers aren't inundated with phone calls, because the minute I do a hard credit pull, trigger leads are sold and their phone lights up like a Christmas tree. It's incessant, it's abusive, it's unbelievable the number of phone calls they get. From the online lenders who are buying from the credit reporting bureau or credit agencies, the fact that a mortgage credit report was full. And they just come in hard and heavy. And that's when you hear stupid things like, I can give you 5 1/4 and a 30-year fix. Name that tune. Right? You go.
So I would echo that. We have a customer relationship management system that we use to set follow-up dates. We also categorize the reasons why all of our clients were nurtured, cash, credit, income, because then we can target information to those groups better on the marketing side. And yeah, it's just, I think the best way to execute on a nurture plan is to work with the agent and decide together follow-up dates together. Like, hey, I'm
You
just
assign leads, right?
What's that?
You assign who your lead comes from, correct? Within your.
Yeah, oh yeah,
database,
yeah. The lead
So when
source.
when that pops back up and they qualify, we're coming right back to
Yeah,
you.
exactly. Or if they referred me somebody else because they appreciated what we've done to help them, that lead's coming right back to you. So, great question.
What else we got?
What
Is there
time
any
is it
on your list?
running? Because I think.
12:15. 1 o'clock.
1 o'clock.
1 o'clock. I think we've got enough to cover for next time.
Sure.
And probably some add-ons.
Yeah.
Unless anybody has any more questions they want
Burning questions?
answered, burning. I think
Dealing
you're
with guys
probably
can
on
leave.
my note about now, guys.
Yeah, it's good information.
A lot of information, and a lot of you are newer, so you didn't know any of it, so it's probably overwhelming. Dan has taped this for you to be able to review it. And especially you newer folks, I would suggest you review it. Okay?
Would it be okay with you if they submitted questions either to me or Dan or to you to start adding to next? I wonder if there's other questions they would want
I
answered.
think that we need a list of questions that you guys want, and why don't you copy it in email to all three of us, okay? Any more things you come up with, but do it in one email, not 10.
Send you
In
an
fact,
email.
Dan, why don't you collect the questions?
Yeah.
and
Don't
then-
send it to Sue.
Huh?
Yeah.
Don't send it to
Don't
Sue.
send it to me.
Send
And
Dan
then,
any topics you want covered.
yeah, I'd like to see it.
Thanks,
Okay,
guys.
thank you,
Yeah,
everybody.
thanks, guys.
Thank